Today, our guest usually joins us from Australia, but he's right here in the studios. Peter, thanks very much for joining us.
Good morning, Ashu.
CEO at XM Australia. Peter, let me just start out by first asking you about all the redemptions that we're seeing in the UK market.
Yeah.
And now I think the Bank of England is talking about giving a notice period for redemptions, not allowing redemptions at any particular time. I'm just wondering about the contagion effect of what's going on in the UK right now. It was just 6 funds. Could this expand further? Because investors are very jittery about having mutual funds or property funds not paying back their money when they need it.
Absolutely. I mean, this is a great concern, and I think it could be some form of contagion. I'm certainly worried about how it spreads into the Eurozone in a whole. But at the present time, you'd have to say it's a worrying thought for the retail investor. And how that moves forward, I think, is going to be a sense of nervousness over the coming months. I would like to see some government intervention or something to settle the market down. But it certainly worries, and it's a major concern for the growing ageing population. Like any investor, they want a return of their money, and they want to know that it's safe, and they want to, if there is a redemption, they want to know that they can action those funds and action them quickly.
Right. Peter, I was looking at some data from one of the major investment banks, and they said if you look at where investors are short, institutional investors, they're actually short emerging markets. That's the highest. And I was just wondering, given the current scenario where we're getting record inflows into India, into mutual funds, and usually funds get into the top 50, 100 stocks, where that's the case with all emerging markets. Could you have a situation where it's just forced buying along with short covering that could put the index up by about 8–10% very quickly?
I wouldn't be surprised. I mean, there's those sort of concerns. We see those big pension funds, and certainly they look at markets, and emerging markets have been dynamic over the last couple of years. I think that will continue. There's certainly, when you look at the Eurozone, you'd have to be very sceptical with, negative bond rates and so on. That really puts a fear mentality across investor land, and these emerging markets are very dynamic across from India all the way across to Asia. I've just been in Malaysia over the last few days, booming economy, absolutely on fire, and you see Singapore as well. So that Asia zone, I think, will continue with strong demographics, a large appetite for construction and, of course, infrastructure and all forms of technology. And I think India is certainly, partnering in those sort of mindsets.
Right. Peter, in another time, if we had very good jobs data and interest rates were supposed to go up, you would have seen most markets go down severely.
Yes.
But we're seeing the reverse now.
Absolutely.
Because nobody's looking at interest rates anymore. My question to you really is that what happens to emerging markets? Because now that fear that an increase in US interest rates is going to move the money seems to have gone out. Because nothing happened to the market when they looked at that jobs data. In fact, they said, oh, that's very good for the markets. How do you see
the crude market.
Bad for the crude market. And how do you see the US market now moving compared to the emerging markets? So which is going to outperform?
I think, when your point earlier as far as that huge growth since late 2008, 2009, as far as the Dow, S&P and NASDAQ, it's just been, shoot the stars out, was massively oversold, and that was corrections from the GFC. I would say that the US market, that with some trepidation, you've got to look at earnings and you've got to look at what's happening as far as their what's over the last, say, 4 to 5 years. It's been one-way traffic. I think it'll come to a point sometime this year. We're worrying about what's happening with the election coming up. Sure. You're worrying about other countries falling into that contagion as far as the Brexit. And if that does spread across Europe, that's going to lead a level of uncertainty. I think emerging markets could be a stronger point. I'm keeping a close eye on the gold market, where crude is. I mean, who would have thought? We're at 46 on the Brexit, was sold down, rallied very strongly to 49.5. It's back at 45, and I think it seems to be where it's going at the moment. It'll probably be a $43 trade sometime this week. So wonderful volatility swings, and then the gold market. So, yeah, it's certainly there's certainly plenty of volatility, and that's a wonderful friend for any trader.
Right. I just wanted to come to the point of how we lower our standards in terms of what yields we'll accept. So, if you use the capital asset pricing model, many of the risk-free yields are 0 or negative. But some would say that's not a right measure to look at high-yielding debt, but high-yielding debt itself is starting to pay really low rates.
Yes.
What's the danger here, Peter, that, obviously governments may not default, and the German bond, you may still get your money back, but if you use that as a benchmark and put 600 basis points and bought a high-yield bond, that could default pretty quickly. How serious is that issue? Because most of the money seems to be going into these high-yielding bonds.
Absolutely. You know, you're seeing that. I was reading in the Financial Times as far as junk bonds and so on. The appetite there is very, very strong for corporate bonds and so on. So people, any fund manager and any large-scale traders look for return, and they look at the CAPM. We all did that at business school, and we understand the philosophy behind it. But there's also the risk metrics, and people are prepared to take some form of risk for a better return. And at the present time, that seems to be the avenue that many traders or many investors are looking at. Right. Will it continue? Well, unless we see some sort of upward trend as far as the Fed, and it's a mixed bag. Some people are saying we'll see something this year. I certainly don't. I think it's going to be a 217 trade, if at all. It might be 2018 until we see some form of upward trajectory. So that could lead more people into those high-yield junk bond style returns.
Peter, we still don't have any REITs, but I'll just come to that in a minute for markets like Malaysia. But in the Indian market, there's a general belief that the bond funds are safe.
Yeah.
And so the bond funds, to give higher returns, usually will go ahead and buy corporate bonds.
Of course.
But we, of course, have a major banking crisis that comes from the fact that many of the corporates are not able to pay back their debt.
Yeah.
How safe are the bond funds? Because, first of all, liquidity always becomes a problem in the corporate bonds.
Yes.
Should you stick to government yielding kind of bonds, even if they give you 300 basis less or 400 basis less, or try these corporate bonds? Because when there is a redemption, the basic problem is nobody's out there to buy these.
Yeah, exactly. Well, that's the great challenge. As far as you've got to look at your risk metrics, you've got to look at a portfolio-based approach as far as how much of a percentage do you allocate to each particular avenue. And I think that as far as the retail land is concerned, there's a sense of scepticism and a sense of fear. They're just, one-way traffic, and they just look at stock markets, and they may just look at, they look at the earnings and try and trade. But the larger investor and the hedge funds and so on, they'll look at different portfolios and different asset classes, of course, spreading their risk and trying to average down their particular return. And if they see something running at a 5 or 6% yield, they'll take that opportunity, and then they'll look at also the bund, and they'll spread that risk. I think it's a very unique time. We will look back in 10 years' time and go, wow, that was certainly fascinating. Where we saw in 2009 and where we're now in 2016, it's defied logic in a lot of ways. Are we out of that GFC mode? In some ways, we're not. And we're now looking at the gold trade. Is it a stable economy? When you look at in UK pounds, gold's up 45% since the start of the year. I mean, that's an enormous number.
Right. So you mentioned gold, so I'll take two other commodities, silver and natural gas, because silver has gone from $14 to 20. Some are talking we're maybe back to 79, Hunt brother kind of a scenario, 6 to 49. Your thoughts on silver and your thoughts on natural gas, because that's moved from around 2.14, I think, to around 280 or something.
Yeah. Silver, first off, look, it's been a great trade. It's up, the best part, as you said, nearly 50% over the short run. Silver, for industrial demand, you've got to also consider that, on the futures market, it doesn't have the same sort of volume as far as open interest compared to gold. But I think the great attraction there is that people have really galloped into it at $15, $16 and $17, and it's been one-way traffic. Now, many analysts are saying you may see, Ashu, $30 on sometime in 17. I think the bulls are out, and they're certainly stampeding northward. But that can also, when a market does have that sort of run-up, you can quickly strip $2 or $3 out of it, or $4 in a week. As far as nat gas, well, where do you start? I mean, if you look at nat gas on an historical, it's a wild bronco as far as trading volatility. At the present, yes, up the best part of 30%. Will it continue over the northern hemisphere summer? I've got to take some sort of lead as far as where WTI and Brent trade. If they correct and they down to that 43, 42, then that may take a little bit of the heat out of the nat gas market. But at the present time, you've got to say it seems to be a one-way traffic trade as well.
Right. So let's say I'm starting a new fund, Peter, and I go on that roadshow.
Yes.
And I go to all these California pension funds and the Ohio Teachers Fund, and I say India is a great market, it's growing at 9%. Here's the data I'm facing.
Yep.
As I mentioned, the NASDAQ went from around, so I'm taking two bases, you're right, maybe the 2008 base is very low, from 1,500 to around 5,000. So that's, even if I take a simple interest, that's about 25% in dollar terms for 8 years.
Yes.
That's a very difficult, compounded. So it's very difficult to beat that kind of return.
It's not a bad return.
Yeah, and in 4 years, it's gone from 3,000 to 5,000. So again, you've got almost over 20% right through. If you look at the Nifty, and not just the Nifty, many of the Asian exchanges, even though the Nifty may have moved up, the currency has eaten up everything.
Exactly.
So I'm sitting with zero returns from 2008, and the guy says, you want me to give you $1 billion for what? I'm sitting here, I take no risk, I buy into the NASDAQ and I make this much. What do I say to him? Because this is where you will start getting capital, or you will not get capital because you'll have to explain this theory to somebody. Okay.
First off, I think it's going to be very difficult for the NASDAQ to perform in the next 8 years like it has in the last 8, and the S&P and the Dow. I think that they're, in some fashion or form, probably fully priced. The growth story as far as India is unique. I take on board what you've experienced as far as currency fluctuation and, of course, where the Nifty is, and taking all of those inputs, you would have to say, I think that the Indian market and the emerging markets have got far greater upside over the short to medium terms, running out to, say, 2022, 2023. I look at the IMF numbers and I look at the forecasted growth across Europe has been cut. The Indian numbers certainly haven't been. I still look at that resurgence as far as China and what's happening there. So I not necessarily take my eye off the emerging market story. And I think to some context, you'd have to look at India and say there's far greater upswing and potential over the next decade than you would say from a fully maxed out US market, or certainly a South American market.
Mm-hmm. So, Peter, I want to bring up another argument because I've heard this in a real roadshow. And the U.S. investor says to me, yep, I know China's going to go up and so is going to be India. But instead of trying to go and find local companies that are going to play this out, I got Starbucks, Nike, Gap, Zara, Coke, McDonald's, Louis Vuitton, Google, Twitter, LinkedIn. I can just buy the same things. Right here, dollar denominated, and I can play your markets because these guys are basically getting all their growth from your markets. What do I say to that? Because there is an economic part of the market, and then there is the market. And one of the concerns is, are we really getting economic growth to reflect in the market, or you'll have the economic growth without the market?
Well, that's globalization for you.
Sure.
So in turn, I see where the investor's saying that. And you can't really take his eye off the ball. You can't. It's a hard argument to go against. I'm not sure where they go. Mm-hmm. I mean, I always look at return. You look at the sense of everyone's after some form of prosperity, and a return of your money and a return on your money. And they're two different things. Sure. We've seen that with bund rates, bund yields and so on. The investor globally is very conscious as far as what's happening with these large multinationals and where they're deriving income from. They're worried about currency fluctuations. I think that's why you have to have a broad-based portfolio across many different asset classes to try and get some sort of uplift. Right. Because there are many markets, as been demonstrated, that have performed poorly over the last 6 to 8 years, and other markets have shot the stars out. And you've just got to take that weighted approach, because you can certainly you can go down one road if it's a narrow-based portfolio and absolutely have a very poor return looking back in 5 years.
So, Peter, the point I was trying to drive at is that it's still a difficult sell.
Yes.
Even though I hear a lot of people who come on air saying, India is growing and everybody wants to come in. But when you try to make that pitch, it still sounds difficult.
Absolutely.
Okay, so I'm going to take one more question related to REITs and related to money flows into Asian markets in bonds.
Yes.
The other argument that I've heard is that, everything is fine. Your bond yields are 7%. But let's say I've invested $16 billion in Indian bonds and Malaysian real estate investment trusts, and now I want to withdraw. Yeah. So the first thing you guys do is to put capital controls, which means now I'm dead. because it looked like 7%. I got nothing there. What do we say to that, Peter? Because this has happened across Asia in '98. When things go wrong, you simply
they
go around
wrong
putting
in a big way.
Yeah, and which is not the case in the UK. Which is even in this situation, you can take your money out.
Yeah, that's the dilemma, and that's another point as far as globalisation and money transfer. And investors have to take that on board when they make those initial decisions as far as where to allocate that capital. When you look at that and examine the context, and again the style of restriction as far as taking back your capital, you've got to be conscious that those sort of intrigues and concerns are a great. They limit the capacity for new investors to come on board, and that's really the handbrake, as I see it, as far as the flexibility is for an investor standpoint.
Sure. Peter, let me just take a look at some of the markets, because I think can we bring up the SGX Nifty? Looks like we have a pretty strong day coming up today. I just saw some numbers, so it's up 1.36%. Yeah. So if you're looking at technical levels, 84.60 was the level, and as I'd mentioned to you in the morning before we started trading, and a lot of this has been driven by the fact that you've got those 50, 100 stocks. And, I was looking at the shareholding pattern. Most of it is either with institutions or with mutual funds. So on a rough and dirty calculation, even if you have 5% more bought into the Nifty stocks, you'll get 9,000. I mean, that's how simple the calculation looks. So now, Peter, I'll just come down to, we can look at, as some of the fund managers would say, well, anybody can make money in the short term. The issue is delivering for 10 years. So Absolutely. Right now, we'll just look at the immediate short term. We're getting record inflows coming into, the domestic funds. Yep. And we've also, all new central government employees now go into a defined contribution. It's not defined benefit, which means they can pick. And usually, fund managers who are managing this kind of money leave their investments only in the top 50, 100 stocks, because that's where we have liquidity.
Yes. Same in Australia.
Sure. So could we have a situation where, irrespective of what's happening on global interest rates, what's happening with the US increasing rates, you now have run into a supply choke kind of a situation where the stock is already in strong hands, and any buying basically drives the price up. And so you see a whole boom coming through right through Asia.
Well, exactly, and you've got that weekly flow of capital as far as pension. Mm-hmm. So that just creates its own tsunami, pushing prices higher. But companies have to absorb those, and we're seeing many companies in Australia, the top 50, that have had very flat growth over the last, say, 6 to 7 years. Their dividends have been fairly poor. They're across sectors. As far as the banking, they've had a nice uptick considering where they were in 09 and 10. But if you look at the miners, they've been hammered. And we take on board, and that's a global concern. If you look at the likes of BP, I was looking at some numbers, and these companies are just shredding headcount to try and appease shareholders from a dividend perspective. And that seems to be the way of management at the moment across many of those sectors. So whilst you look at the top 50 to 100 companies, and those funds are flowing in on a weekly basis, you'd have to say, are we going to see long-term growth out of them? Or is it just a little bit of artificial stimulus?
Mm-hmm. Peter, given the current situation, how would you allocate your portfolio? Let's say I'm not risk averse, but I also want to take opportunities if the market was to, basically run into some kind of a credit squeeze or basically have a disequilibrium. How much in cash should I be if I'm looking for a market disequilibrium to occur in the current situation?
I think a lot of traders would probably be 20 to 30, 40%. The other side, of course, is what currency are you going to trade in? And if we're heading into a tough time over the next, say, 12 to 18 months, you'd have to be possibly long US dollar. Have a look at where gold is. I think you have some allocation there from either in an exchange-traded fund or actual precious. Then the other side, what currencies and what companies. So if you've got to protect yourself, maybe healthcare, maybe technology, maybe as far as some of these large multinationals, From where I look at it, you've got to have a very broad approach, because if you've got all your eggs in one basket, you can be left at the gate and look back again in 2 years or 3 years' time and you're down 15 or 20%. So it's far better to have a cross-sector allocation.
Sure. I want to just talk about technology. A bill was introduced in 2010 to basically limit the number of L1 and H1 visas. That bill, the same guys have introduced the bill again in the Congress, I believe, at the moment. And what it says is if you have more than 50 employees, then no more than 50% of your people can be H1 or L1 visa holders. Of course, it's not gone through the Congress as yet, and it's not become an act as yet. What do you make out of this, Peter? Because there is a genuine debate. I know we don't like it outside the US, but there is a genuine debate that the way the H1 visas were being given is by saying nobody in the US qualifies for this job. We all know, because we've all used H1 visas, that that's not true. It's just that you're cheaper than many of the other guys.
Sure.
And that's why you're seeing what happened in Brexit. You're seeing down in the US.
I see it across Europe as well.
Right, and it may not be a sound argument for people who don't live there, but for people who live there and who in Greece, you know, the kind of unemployment, and many of the people are saying, look, I spent a huge amount of money studying.
Yes.
Somebody's come in and taken my job. This is popular stuff. How serious is it for Indian technology companies? Because something revolutionary happened which nobody noticed, was the BPO business completely moved to Philippines.
Yeah.
But now there's a question of what happens to all these IT companies if bills like this fall into place.
Again, it goes back to the globalisation mindset. We saw cheap production coming out of China for many years, and that's been stripped out now in places like Bangladesh and certainly Vietnam, and as you mentioned, Philippines. You have to look at a nimble workforce. You have to look at, if it is technology-based, where can you do it cheaper? And every CEO looks at that sort of, those conditions. So that's been very much a mantra coming from a board. All these guys have got terrific educations from, I'm saying, at senior management level, and they look at how they can get the best return for their shareholders and get the cheapest, those attributes that go into the job. And as you said, you're stripping that out from India and you're going down to the Philippines, cheaper labour. We've got call centres coming out of the Philippines. We've got everything being managed there, and they're highly educated, and it's a cheaper process. So I think that's going to be very much a concern leading forward, and that's where the protectionism and that Brexit mindset. I had some family members from England, and they're very conscious of that, and that's why a large percentage did vote for the Brexit, because they're concerned about their children, they're concerned about their future generations and the protection of their own jobs. And I think that is spreading. You're looking at France, have a look what Italy's mindset is, and I think that will continue across that whole Eurozone. Where it goes for India, I wouldn't be surprised in years to come, and over the next few years, that that's a great issue at hand. And you will get nearly to a point of a race to the bottom as far as cheaper utility costs.
Right. Peter, just time for one last question. We have a traditional definition of defensives, which is, pharmaceuticals or non-interest rate sensitives. In the Asian context, and specifically in the Indian context, maybe defensives are stuff that are, or non-defensives are those like technology, which are impacted by global conditions, and maybe crowded trades like private banks, where just about every investor is invested as a proxy. Your thoughts on that? Because we cannot use the traditional U.S. definition of defensives when we look at markets like ours.
Absolutely. I mean, when you're thinking of the technology, India is that's its great, I suppose. Their hub has been that technology focus over the last 15 to 20 years, and they've championed it and become world leaders at it. Now, is it going to continue? Well, your competitive advantage only lasts so long. Unless you can leapfrog your technology, or leapfrog the incumbent players, and that comes down to resources, comes down to brain, comes down to ability, and when you're dancing in that ring, as a technology player, there can be more nimble players out there that look at opportunity. And if you look at the banking system, have a look where Silicon Valley is now. They've challenged the orthodoxy as far as the banking system globally for small, nimble players to come in, and now you've got partnerships coming from the global banks to small, nimble players to realise, well, these people have got a team of 15 or 20, and they can do what we can do, but they can do it faster, better, cheaper, and with more ease. Right. So it's far better to form some strategic alliance or merge with them to take on board that technology. And this is where it's a very fluid and dynamic arrangement.
Right. So, Peter, you think 10 to 15% returns on a dollar-adjusted basis is possible in India in the next 1 year?
I hope so. Okay. I'm going to employ some capital here. We've just got to find which markets.
All right, Peter. Thanks very much for taking the time for coming in when you're here next in India to join us. Peter Mcguire, CEO of XM.